this online program. I'm sure this will really help you to crack the CAIIB examination, because what we'll be covering in these sessions are some things which are very specific to CAIIB exams, and we even though we may not go very deep into some of the topics, we cover all the topics from the examination point of view. But having said that, wherever the participants need a further going further down deep into the topic, we'll definitely do that. So once again, welcome both of you to this program. My name is Raghunandan. I was with Syndicate Bank for quite some time, for about 24, 25 years. And after my promotion to Scale 5, I quit Syndicate Bank and then joined another Government of India enterprise. I was a zonal head there before. And again, after 4 years, I quit that organization and I got into academics. I was an assistant professor with the Manipal University. And then I became a dean in that university too. And I was in charge of all banking related programs, right? So with this introduction of mine, friends, we'll jump into the topic of the day. Friends, this is module C of advanced bank management, overview of credit management. What is that we'll be discussing here? We have about 1, 2, 3, 4, 5, 6, 7, 8, 9 units to cover. And maybe we may not be covering all the 9 units one by one. What we'll do, we may be combining some units which are connected with each other, but rest assured, all the topics would be covered in this in these sessions of about, we have about 6 sessions, right? 9 hours. So we'll be covering all these things. We will be sharing with you at the end of the day, after the session, slides on the topics that we covered during the session, so that you'll be able to go through the slides and note down any doubts that you would probably get for further clarification. The clarifications can be had through the common WhatsApp group, or I'll be sharing my WhatsApp number with you at the end of the session today, or my email ID also with you, so that you are free to connect with me for any of your doubts. Okay, friends, what is that? Yeah, friends, just one clarification, just one confirmation whether my voice is carrying to you and whether you can see the PPTs on the screen. Yeah, fine. Is this space okay with you? Friends, Unit 17 is an overview of credit management, wherein we also look into the priority sector advances, the MSME, with particular emphasis on the targets and the sub-targets. Unit number 18 is where we'll be analyzing various ratios. It is, in fact, an analysis of financial statements. Unit 19 is on assessment of working capital finance. Unit 20 is an assessment of term loans, where we will discuss on tools and techniques and the ratios concerned for assessment of term loans. Unit number 21 is on credit delivery and straight-through processing. Unit 22 is on credit control and monitoring. Unit 23 is on risk management and credit rating. Unit number 24 is on restructuring, rehabilitation, and recovery. Unit number 25 is on resolution of stressed assets. Focus would be on IBC 2016. Yeah, friends, you all know that a bank has to lend, because the definition of a bank itself is that accepting deposits for the purpose of lending and investment. See, the bank cannot invest all the deposits it mobilizes, for the simple reason that the investment may not give the bank adequate return to meet the cost of deposit by way of interest and to meet the other administrative cost. So the bank has to necessarily lend, right? And since it's a public money that the bank is lending, the bank has to follow certain cardinal principles of lending, so that what the bank has lent, the bank would get back the money with interest. Today, we'll be discussing in this first slide on what are the cardinal principles of lending. Friends, you would have to remember this acronym, SLIPS, SLIPS. The first S stands for safety of funds. As a banker, when I lend money in the market, when I lend money to my borrowers, I always would like to ensure the safety of my funds. What is safety? Getting back my fund with interest, right? In fact, there are some points that I would look into to ensure the safety of funds. We call them 7 C's. What are those 7 C's? This may be a question in the examination. Uh, Character, character of the borrower, capacity of the borrower, both financial and managerial capacity, capital, whether the borrower is in a position to bring the margin or to infuse capital as and when it is required for furthering the business, collateral, whether we should take any additional security to secure our advance, conditions, what are the conditions, both internal and external, which would probably help me in recovery, which would help the borrower to run his project smoothly, to generate income out of it and repay the loan. Is the condition good or is the condition bad? Right? Cash flow. Does the business have adequate cash flow so that the loan installments can be serviced? What is the credit worthiness of the borrower? See, these are the 7 C's, looking into which you can, to some extent, ensure the safety of funds: character, capacity, capital, collateral, conditions, cash flow, creditworthiness. The question on this might be like this: identify the one which is not one of the 5 C's or 7 C's, right? So you have to remember this: character, capacity, capital, collateral, conditions, cash flow, creditworthiness. These are the 5 C's. Then what is creditworthiness? See, it is the capacity to repay and the willingness also to repay. It's not enough if the customer is capable of repaying. We also have to look whether he has got the intention of repaying. How will we do that? See, the CIBIL report will give us a fair indication of his willingness to repay, his intention to repay. In the CIBIL report, if you see that he has borrowed maybe twice in the past, thrice in the past, and he has cleared the loan in full which he had borrowed, then it suggests that yes, he has got an intention to repay. He may not become an intentional defaulter or a willful defaulter. But again, friends, CIBIL is nothing but history. You also have to look forward. CIBIL is what he has done in the past, which may not hold good for what he would do in the future, right? Then liquidity. See, the bank lends keeping in view its liquidity position also, because we finance infrastructure projects, we fund home loans for a quite a considerable period of time, maybe extending for 20 years, 25 years, home loan even for 30 years. Whereas most of our deposits are short term deposits, ranging from a tenure of 1 to 5 years. So banks cannot lend on long term with the short term obligations, right? The challenge is to balance both. The challenge is to balance both, but with better liquidity and risk management, better liquidity management and risk management, the banks are balancing both. In fact, we have a committee called an ALCO committee in every bank, which takes care of asset liability management. ALCO is Asset Liability Committee, and they ensure that there are no mismatches. Then income generation. Banks also need profit. Profit is not a dirty word for the banks, right? We also need profits. So have to um, banks have to analyze the customer profitability. We call it customer profitability analysis. The banks have to analyze what is the profitability that I can generate from this customer. Of course, you all know it is through upselling, it is through cross selling, right? The customer becomes the central focus of income generation, not only for the bank, but also the business which we are financing should have the potential of generating income, so that the loan obligations could be met, right? Then P stands for purpose. Purpose should be legal. So banks cannot lend for speculative purposes or unlawful purposes, even though there is an assured income generation. We look into the purpose for which we lend. Finally, we come to spread. Friends, this spread has got two meanings. One meaning is uh, when we receive interest on loans, we call it yield, which is our income. When we pay interest on deposits, we call it cost, which is our expense. So the difference between the yield and the cost is called the spread. That is, what is the amount of profit we are making. This spread determines what is the net interest margin, what is the net interest income for the bank. That is one spread. The other spread is where we spread the risk. See, the banks don't lend to a particular geography. The banks don't lend to a particular sector of the economy, right? They spread their loans across geographies. They spread their loans across sectors for a simple reason that if one geography is affected from any natural calamity or one sector is not doing well, the bank is able to realize its money from the other geographies they have given loan, where they have given loan, and from the other sectors to which they have given loan. So the cardinal principles of lending can be encapsulated in one acronym, SLIPS, SLIPS: safety, liquidity, income generation, purpose, and spread. Now, these are the different types of customers who can also be your borrowers: individuals, non individuals, illiterates, visually challenged, minors, married women, pardanashin women, sole proprietary concerns. When it comes to non individuals, partnership firms, LLPs, Hindu undivided family, clubs, associations, trusts, cooperative societies, companies, one person companies. So you will be dealing with all these types of customers when you are extending a financial facility, right? Now we will look into what are the different acts that govern each type of borrower. Uh, the act that governs individuals and sole proprietorship is the Indian Contract Act, because while extending a financial facility, you are in fact entering into a contract with the borrower. So it is governed by Indian Contract Act 1872. Partnership firms governed by Indian Partnership Act 1932. Limited liability partnership governed by LLP Act 2008. Companies, private, public, OPCs, they're governed by Companies Act 2013. Statutory companies, they are governed by whichever act they have been under which they have been created. Trust, trust is governed by Indian Trust Act, Public Trust Act, Hindu Religious and Endowment Act, Waqf Act, etc. Cooperative societies are governed by the Cooperative Societies Act or the Societies Registration Act. Clubs and associations, they are governed by the law under which they are registered. Local authorities, Panchayat Raj, respective state acts. Joint Hindu families, they are governed by Hindu customary law, depending upon whether they are formed under the Mitakshara law or the Dayabhaga law. Now, we all know what a partnership is. A partnership is an association of persons who have agreed to carry on a business. A business can be done by any one of them acting for all or all of them, and they have agreed between themselves to share the profit or loss out of the business, right? Now, we have to, while extending loan, we see that we extend loans only for registered partnership firms, because unregistered partnership firms, they suffer from some limitations, right? What are those limitations? The firm cannot sue outsiders but can be sued. That is, if a bank gives a loan to an unregistered partnership firm, the limitation is the unregistered partnership firm may not be able to sue outsiders. For example, they would have supplied goods to an individual or to an organization. They have not received money for that. So they will not be able to lodge a complaint. They will not be able to file a case against them, right? Or whereas the others can file a suit against them. For example, someone has done some supplies, raw material supplies to the partnership firm, but they have not paid. But a partnership firm can be sued, but the firm cannot sue outsiders. Then partners cannot sue themselves or the firm. The partners, in case of any disagreement, cannot file cases against each other, or they cannot file case against the firm. So this is basically two limitations that a non-registered partnership firm suffers from. Okay, and the partnership firm should be registered with registrar of firms and assurances. Unless the firm is registered, the banks do not extend financial facilities. Partnership deed may be registered or otherwise, but it is better it is registered. Now, in order to bind a firm, the partner must do the activities under the name of the firm. If the partner comes to you for a financial facility, you will be extending the financial facility in the name of the firm, right? The documents had to be executed on behalf of the firm. For ABC Enterprises, authorized signatory, the partner, right? The partners are jointly and severally liable for the acts of the firm. That is what we call unlimited liability. So they are jointly and severally liable. Rights of the partner can be restricted. So you will have to go to the partnership deed and see whether any right of any partner is restricted, right? But the law protects us. It says if a third party has no knowledge of such restrictions, then the firm would be liable for the acts of the partner. Okay. What is the maximum number of partners in a partnership firm? As per the Companies Act 2013, the minimum number is 2 and the maximum is 100, but the central government has restricted it to not exceeding 50. So if there's a question in the examination as to what is the maximum number of partners in a partnership firm, as per Companies Act, it is 100. But if the question is what is the maximum number of partners allowed in a partnership firm, the central government has now restricted it to not exceeding 50, right? And you all know that a minor can be admitted to the benefits of the firm, but there should be at least two major partners. But friends, again, a minor cannot become a partner right from the registration of a partnership firm or right from the day a partnership is started. That is, a minor cannot, a partnership firm cannot be started with a minor as a partner. But once it is started, a partnership is formed, a partnership deed is written down, right? Then the partners may decide to take a minor also as a partner. So a partnership firm cannot be started as minor with a partner as a partner, but after the partnership firm starts or it comes into effect, a minor can be admitted to the benefits of the firm. But you will have to ensure that in case you have given a loan to a partnership firm where a minor was involved at the time of giving a loan, on attaining majority, the minor partner should become a normal partner, or he has an option to quit the partnership, but he has to give a public notice and inform the registrar of assurances and firms that he is quitting or he is continuing, right? And he has to do this within 6 months of attaining majority. If he does not do it, it means that he has continued, he has opted to continue as a partner. Now if he continues as a partner after becoming a major, he is responsible for all that the firm has borrowed even during his minorityship. But if he says, no, I will not become a partner, then the minor, even after become majority, if he opts out of the partnership firm, he is not liable to the for the financial facilities availed, right? It is only limited to his share in the partnership firm. Okay. So while granting loans to a partnership firm, what are the precautions we take? Firm is to be registered. You have to scrutinize the partnership deed. If a partner is a company or a LLP, because a company or a LLP can also become a partner in a partnership firm, you will have to ensure that the charge is created with ROC, right? All this we'll be discussing when we come to Companies Act. Down the, I think, as and when we progress in this in these sessions. Okay. HUF. HUF is not registered under any specific act. It is a legal entity recognized under Hindu law. It applies to Jain, Sikh, Buddhist families as well. The eldest family member is the Karta or the manager, who is the owner of the property. Owner in the sense is the senior most member, right? And the other members of the family, they are called co-parceners, right? The karta looks after the whole business. The position by birth in the family. That means someone can become a member of the family only by birth. Then Karta's liability is unlimited, whereas the liability of co-partners is limited to their share in the property business. That means if, let us say, the property business is 100 rupees, right? And there are about four people who are members of the Hindu undivided family, each will be having 25% share. One of them will be Karta. And if you are giving a loan of, let us say, 1000 rupees to them, Karta's liability is unlimited. He has to repay the entire 1000 rupees. His liability is unlimited, whereas the liability of the co-partners is limited only to the extent of their share. That is, they can say my share is 25% in the property, so my liability is restricted only to my share. So co-partners liability is restricted to their shares, whereas the karta's liability is unlimited. Okay. There are two schools of thought under which HUF is formed. One is Dayabaga and another is Mitakshara. Now we have to understand what is the difference between Dayabaga and Mitakshara. Uh, See, Mitakshara grants, a HUF is formed under either of these two laws, right? Dayabaga is applicable to states of West Bengal, Assam, and Tripura. Whereas in the rest of the country, it is the Mitakshara law that prevails, right? Mitakshara law has now done away with gender bias. Now, daughters also can get the right through birth in the family if the HUF is formed under Mitakshara law. And number two, Mitakshara, even though the Karta is alive, the co-partners have got a share in the property. They have got a right over the property to the extent of their interest in the property, right? So, under Mitakshara, even when the Karta is alive, the co-partners can insist for division of property. Whereas in the Dayabagala, if the HUF is formed under Dayabagala, the Karta is the absolute owner of the property. The co-partners have no right to seek division of the property as long as the Karta is alive, right? Then there can be a question on this. Can a female become the Karta in a HUF family? The answer is yes. If the female is the eldest major member in the family, the female can also become a Karta. But if there are any other male member who are majors in the family, then the male member will automatically, the eldest male member will become the Karta. When will the female member become a Karta? When there are no major male members in the family and the female member is the only major member in the family, then the female member can become the Karta. Okay. Yeah. What is that we had to see? We had to take the loan application either to open the account or to give a loan to be signed by the Karta and all the major members of the family, because we will have to make the co-partners also jointly and severally liable. I told you the law says the liability of the co-partner is limited to their share in the property. To avoid that, we also, what we do, we take their signatures also in their individual capacity so that they are also liable to the entire loan amount that we have sanctioned to the HUF. On death of the Karta, senior most member will take over as the Karta because it has got perpetual existence. HUF is closed on partition or division of the property or business. Okay, friends, I'll stop here for some time. Any questions you have on partnership or on yeah, companies. The companies can also become your borrowers, right? A company is a legally constituted entity under the company law. It is an artificial entity and registration is mandatory with the ROC. These are certain things that you would be knowing. It's just a reinforcement of what you already know. A company may enter into contracts in its own name, can also be fined, all those things, right? It can acquire and dispose properties. A company can sue others and can be sued in its own name. It's a legal entity separate from its members. Minimum number two, and maximum is 200 in case of private limited company. It might be a question. Case of public limited company, minimum number is 7 and there is no maximum limit. Okay. What are the essential features of a company? It is limited liability for the shareholders or the directors, perpetual existence, transfer of shares. You can freely transfer shares in case of a public limited company. Common seal. A company has got a common seal, but nowadays common seal has lost its significance because the Companies Act says common seal is no more required to be affixed on the loan documents of a company. It's optional now. Previously, it was mandatory. Okay. Private limited company, uh, where the minimum paid up capital stipulation is waived. Shares are not freely transferable. That means public subscription is not there. Total number should not exceed 200. Acceptance of deposits from third parties is prohibited in case of private limited company. Public limited company is one which is not a private limited company. Minimum 7 members and maximum unlimited. They can issue shares, debentures, and accept deposits from public if it is permitted, whereas they can freely transfer shares and debentures. They can issue shares and debentures to the public. There are different types of companies. One is the government company, where the government holds the majority share. Example, ONGC, IOCL, BHEL, GAL, GAIL, HAL, SAIL, SAIL, Steel Authority of India Limited, LIC, SBI. These are all government companies, and the subsidiary of such company is also a government company. For example, Mangalore Refinery and Petrochemicals is a subsidiary of ONGC. The fact that ONGC is a government company, MRP also becomes a government company because it's a subsidiary of government company. Section 8 companies. Section 8 companies are those companies which are formed for a specific social purpose, right? They are formed for charitable purposes. They play a key role in reviving the social change. They have to use profits to support the causes they stand for. It may be education, healthcare, environmental protection. They cannot distribute the profits as dividends, but they have to use the profits only to further the cause that for which they have been formed. Some examples are BCCI, Infosys Foundation, Azim Premji Foundation, CRY, Child Relief Fund, Smile Foundation, Akshaya Patra. All these are some examples, right? Then foreign companies. Foreign companies are companies which are headquartered outside India, but they have presence in India either through branches or through their agents, or they may also be having just digital presence in India, like your companies, right? Which have only digital presence in India, not a physical mode. E-commerce platforms. Okay. Example of foreign companies can be Google, Accenture, Toyota, Visa, Mastercard, all those who are headquartered outside India. Then we have got one-person companies. One-person company, one person starts the company, right? But since one of the main features of a company is perpetual existence, the question is, who will run the company after the death of the one person, of that person who has started the company? So in case of one-person companies, the promoter has to nominate a person who will run the company after his death. Okay. And that nominee should also file his consent. That consent of the nominee is important. So when it is said that in case of OPCs, nomination is permitted, it is not for bank accounts. Nomination is only to run the business on the death of the promoter, of the single promoter, and nomination is registered with ROC, and that nomination should have the consent of the nominee, right? Then we have got a small company. What can I say, a question, right? What is a small company? Please listen carefully. A private company whose paid up capital does not exceed 10 crore and whose turnover does not exceed 100 crore. It's a small company. A small company is one where the paid up capital does not exceed 10 crore and the turnover does not exceed 100 crore, right? This may be a question, right? And similarly, for one person companies, there is a threshold limit. What is the threshold limit? The paid up capital should not exceed 50 lakh, or the turnover should not go beyond 2 crore. If there is a breach, the paid up capital of a one person company goes beyond 50 lakh or the turnover goes beyond 2 crore, then that one person company gets automatically converted into a private limited company. So one person company can exist as long as the paid up capital does not exceed 50 lakh or the turnover does not go beyond 2 crore. This can also be one of the questions, right? Yeah. Then what are the documents you take? We know all these things. Memorandum of association, it's an external document, it's a public document. What is the objective of the company? What is the liability of the shareholders? What is the name of the company? Where is the company registered? Right? All these things are found in memorandum of association. Most importantly, the objective clause. Right? The bank. See, friends, what I will be covering here is you all know that MOA has to be obtained, AOA has to be obtained. But what is the manner in which you have to obtain the AOA and MOA? This is what I would like to add here, right? In most of the banks, we see that MOA and AOA are obtained as they are, and they are just pinned with the account opening form or maybe with the in the loan file, right? If a loan is given, but there is a specific method of obtaining it. What is that method? On the on the front cover of the MOA, which is obtained as a book, one of the directors should sign, put his full signature, and write, "This is the recent and updated version of MOA and AOA." He has to do that. And all the pages, the company has to affix a round stamp and any director can initial it. Again, on the last page, the full signature of the director has to be obtained with the company rubber stamp, right? This is how a MOA and AOA has to be obtained. But unfortunately, even while opening accounts or even while giving loans, they are obtained just like that. No signature, no declaration that it is the recent and the most recent updated version. You'll have to do that. Okay. Then AOA is all about the internal document of the company, which only the company need to know. The general public need not know. Okay. AOA is subordinate to MOA. Then we have got certificate of incorporation, which is a birth certificate of the company. Then certificate of commencement of business. Friends, previously, while giving a loan, we used to insist on certificate of commencement of business only from public limited companies. We never insisted it from a private limited company. But now, the Companies Act says that if at all there is a paid up capital, if at all that company is having a paid up capital, then before giving loan, certificate of commencement of business is to be obtained for both public and private limited companies, right? This is one change that has been brought about now. What else we take? We take a resolution. We take the document. We get the documents executed as per the resolution. We register the charge, right? A company is free to borrow up to its paid up capital plus free reserves above the limit, right? Suppose the paid up capital is 1 crore, free reserves is 2 crore. The company can borrow up to 3 crore. But if the company wants more than 3 crore, right? 3 crore is only an example I am giving you. It is in fact paid up capital plus free reserve, whatever is the amount. About that, a special resolution is required to borrow, right? Most importantly, what you have to see whether the purpose of the loan is aligned to the objective clause. For example, in the MOA, the objective clause would be given. What is the objective for which the company started, right? If the company says, if the MOA says the company is started to run a chain of educational institutions, then whatever loan you give, that purpose should be aligned to the objective. So you may give loan for building classrooms, for building hostels, for purchasing vehicles, for transporting students, for construction of lab, so on and so forth. But if the company comes to you for any other purpose, for example, they may come to you and say, kindly give us loan for development of resorts, right? This is not an acceptable purpose because the purpose is not as per the objective clause. So you cannot give a loan. So make sure that you are giving a loan to a while giving a loan to a company, that the purpose is aligned to the objective clause, right?